Good evening, students. Welcome to the session. So, today we are going to look at the taxation of the trust, assessment of the trust. We are going to start with that particular topic. I hope you have revised this particular topic so that we are able to solve the questions also on this particular area. Let us start with it. So, first of all, we are going to discuss about the securitization trust. What is the securitization trust, student? Yes, what is securitization trust? Yes. What is securitization trust?
Ma'am, good evening, ma'am.
Good evening.
Yeah, securitization trust is created during the process of the securitization process. They will collect the money from the investor and they will give into the securitization, the bank, financial institution in turn. For that, they will charge some commission out of it, which means that bank will will give the loans to the various discipline like CC, home loan, that vehicle loan, like that, the various loan, out of which they will collect some security. That security, the whatever the fund is given to the say holder, it will be the illiquid, so it will be ideal for the get that illiquid asset to the liquid asset. They will create the form of the securitization process. During the process, the securitization trust will be created. In the trust, what will do, having that, keeping that amount, they will get some investment from the various investors, and based on the investment fund, the securitization trust will give the amount to the banks. And whatever the during this process, whatever the income earned by the securitization trust, whether it is a capital gain or business income or income from other sources or whatever the case, it will be passed through the income to the investors as it is. It will be taxed in the hands of the investor, not by the trust. Whatever the income earns is exempted from tax.
Yes, absolutely. So you rightly summarized what is securitization trust. So basically, securitization trust, as he rightly mentioned, will be basically obtaining the assets from the bank or the financial institution. So what they do is basically they, loans. Bank gives the loan to the borrowers, right? In the security or basis the security of the asset. So when the banks receive the asset, they are not of any use. So to monetize that asset, the bank will pledge the asset with the securitization trust and obtain the funding. Okay. So the securitization trust will give the fundings to the bank on the basis of pledge of assets, and the securitization trust will then obtain the funding from the investor by issuing the security notes. Okay. So how does the taxation of the securitization trust happen? Securitization trust is known as a pass-through entity. What do we mean by pass-through entity? That the income of the securitization trust will be exempt in the hands of the trust. It will be taxable in the hands of the investor. And it will be taxable in the same manner as if investor had directly invested in underlying asset. What do we mean by that? So let's say, for example, if securitization trust has earned the income from PGBP, IFHP, IFQS, so when the income will be distributed to the unit holders, in the hands of the unit holder also, whatever income is distributed will be taxable in the same manner as if they had invested in directly asset. So in the same ratio itself. So the nature and the characterization of income in the hands of investor shall be of the same nature and in the same proportion as if it was received directly by securitization trust. What is the TDS? Securitization trust will have to deduct TDS.
Yes, ma'am. While they're distributing the income to the investors, that securitization trust will deduct the TDS. If it is a resident holder, then the TDS will be 10%. If it is a non-resident, rate as per in force. The example, as per the Finance Act, what is the rate applicable, or the TTA agreement, whichever is beneficial to them, according to it, that the securitization will the securitization trust will deduct the TDS and remaining amount will payable to the investors.
Yes. So securitization trust will deduct the TDS under 194 LBC. When it pays to the resident unit holder, it will be 10%. For non-resident unit holder, it will be the rates in force. Very simple. Okay. Next is the alternate investment fund. What are AIFs?
Alternate investment fund is also is a fund. Here also the various investor will be there. Investor will invest the fund into the investment that alternate investment fund, from where the investment fund will be invested in the various items, from where the investment fund, that is a business trust, will get the income in the various ways and means, from the BGPP or capital gain income for other sources or a house property. But here, there also differentiate from that alternate investment to the securitization fund. Here also the pass through will happen. Whatever the BGPV income is received by the alternate investment fund, it will be taxed on the hand of the alternative investment fund itself.
Yeah.
The remaining will be passed through to the investors.
Okay. Yes. So alternate investment fund, what does it do? It basically makes the investment in different kind of assets. Okay, not assets per se, but different kind of ventures, right? Startups, in the listed equity shares, right? So it makes the investment into the funds, right? These are special funds, the investment funds, right? So there are, two categories of AIFs, category 1 and category 2. These are again SEBI regulated. So they are basically investing in the startups, in the venture capital, right? So these are basically collecting the investment and investing in the businesses, which is called as the alternate investment fund. Now, their taxation is not similar exactly to securitization trust. Of course, they are also having the pass-through status, but the taxability is dependent on what is the category of income. So if your income is in the nature of PGBP, if the AIF's income is in the nature of PGBP, the taxability will be in the hands of the AIF itself. Now, if the AIF is a company, the tax rate will be 30%, 25%, or 22%. If it is LLP, then it will be 30%. If it is incorporated as AOP, BOI, or a trust, it will be at the maximum marginal rate. And the income will be exempt in the hands of the investor under 1023 FPB. If it is other than PGBP income, then it is not taxable in the hands of the AIF. Then it will pass through to the investor. Then it is taxable in the hands of the investor, again in the same proportion and in the same nature as if it's directly received by the investor. Okay. So basically, if the AIF distributes the income to the unit holder, which is not in the nature of PGBP, let's say it is IFHB, capital gain and IFOS, it will be taxable in the same proportion as if it was received directly by the unit. And when the AIF distributes that income, it will have to deduct the TDS under 194 LBB. For resident, it is 10%. For non-resident, it is at the rates in force. But when it comes to the losses, if it is business loss, then since the business income is taxable in the hands of the AIF, the losses are also to be allowed and carry forward by the AIF itself. It will not be allowed to the investor. However, when it comes to the other losses, then the losses are not allowed to be set off at the fund level. These will be allowed to the investors if the units are held for greater than equal to 12 months. But before you venture into the set off of the losses or the carry forward of the losses, you need to see whether there is interhead or intrahead set off at the fund level itself. And then you need to decide about the carry forward of the losses. Let us solve one question from the module on this point.
Yes, ma'am.
Let me just share.
Ma'am, I
Yeah.
think, however, the long-term capital gain is not allowed to set up, even though in the interhead, it's not allowed.
No, long-term capital loss will be allowed only against the long-term capital gain itself.
Yeah. Only long-term capital loss is allowed to only long-term capital.
Yeah, so
In
the
case
rules
of the
remain the
other
same.
losses,
Yeah,
same.
rules for all the type of losses are same as what you have under 70, 71, 72. That doesn't change. Okay.
Yes, ma'am.
So let us solve a question. The following are the particulars of income of four investment funds for previous year 25-26, A, B, C, D. For A, it is capital gain, income from other sources. For B, it's business income, capital gain and other sources. C, it is loss under the business income, loss of capital loss and the IFOS which is there. For D, it is business income, capital gain and other sources loss. Compute the total income of the investment fund and each unit holder, assuming that each investment fund has 20 unit holders, each having one unit held by them for a period exceeding 24 months. And the income from the investment in the investment fund is the only income of the unit holder. So first we will compute about the A. So how will the taxability happen with respect to A's unit holders and the fund A?
Ma'am, since there is no business income, there is no taxability. For capital gain and income for other the same proportion, it will move to pass through to the investors.
Correct.
In this case, the capital gain 16 lakhs divided by 20, so 80,000 will be for each unit holder 80,000 on their hand. It will be taxable. Income from other sources is the 4 lakh divided by 20. It will come to 20,000. 20,000 will be taxable as a income from other sources in the hands of the investors.
Yes. So for A, since there's no business income, it will not be taxed, right? However, for other income, the income will not be exempt in the hands of A and it will be taxable in the hands of the unit holder. So 80,000 capital gain, 20,000 income from other sources. Same ratio. Because they have distributed the entire income, which is 20 lakh. There are 20 unit holders. So 1 lakh each. 1 lakh will get the income or the income will get taxed in the same proportion as the AIF has earned it, which is basically 4:1. Right? So you will distribute 1 lakh also in the same ratio. What about the fund B?
Fund B, that the income from business income is taxable in the hands of trust itself, the investment fund itself, and for cap the same that the 14 lakhs divided by 20 thousand, it will be taxed in the unit holder on the capital gain on the head, and 4 lakhs also it will be taxable in the hands of the unit holder the for 20,000. 4 lakh divided by
Yes.
20.
So 2 will be taxable in the hands of the fund only. It will be exempt in the hands of unit holder. 14 and 4, right, will be taxable in the hands of the unit holders, right? So again in the same ratio, 70:20, right? Because 90,000 is what you will get. 18 lakh is there, 20 investors are there. So each investor will be getting 90,000, right? So 90,000 in the ratio of again 7:2, the taxability will happen. Next about C.
See, there is a loss for them. This is a business loss. The business can be can be at the investment fund itself. They can carry forward the subsequent years and set up. And with respect to capital gain, there is a business of 2 lakhs which can be set off from the income from other sources. 8 lakhs is there, so sufficient fund is there. So 2 lakhs minus 2 lakhs, the taxability in the hands of investment will be zero. In the income from other sources, it will have the remaining balance of 6 lakhs. The 6 lakhs will be taxed under the unit holder 6 divided by 20, 30,000. Capital gain of loss will 6 lakhs will be there. It will go to the unit holder. If the unit is holding the 12 months or greater than 12 months, they can carry over to the next year. Otherwise, they cannot carry over.
Yeah, absolutely. So if you look at it, so 2 lakh which is there, right? This is the business loss. Now, what most of you would tend to make a mistake is you would see that, let's say, for example, that 2 lakh we will set off at the fund level, and the balance amount which is there, you will say that 8 lakh is taxable in the hands of the unit holder. Okay? You would try to do that, but that is a mistake. isn't it? Why that's a mistake? Because as I told you that first you need to set off as per the laws set of rules. And then you need to think about the carry forward. Right? So, two will first get set off with the income from other sources. Can you set off capital losses against income from other sources? Right? We
No,
cannot.
ma'am.
So, we can set off the business loss against income from other sources. So, in that particular case, you will set off this 2 against the 8. So only 6 will be taxable in the hands of the unit holder. So 6 lakh divided by 20, 30,000 will get taxed in the hands of each unit holder. And this 6 lakh which is there, this will be carried forward by the unit holder in this 6 lakh, which is 6 lakh divided by 20, will be carried forward by the unit holder because they have held one unit for greater than equal to 12 months. Are we clear? Now there is a follow-up question here. If the investment fund sees the following income component for next year, AY 27-28, what would be the total income of the fund and the unit holder for that year? If the business income is 2 lakh, capital gain is 9 lakh and IFOS is 8 lakh.
In this case, the business income 2 lakhs is taxable in the hands of the investment, and the capital gain will be taxed under the unit holder. Already they have the 6 lakhs loss, they can set off against it. Remaining 6 lakhs, with the 3 lakhs only is taxed in their hand, divided by 20. Income from other sources, 8 lakhs is directly taxed under the unit holders, divided by 20.
Yes. So basically, now you will not, make last year 2 lakh against this 2 lakh because you already set off from income from other sources. So this 2 lakh will be taxable in the hands of the fund itself. Right? And this 9 lakh which is there, out of this 9 lakh, you will set off this 6 lakh because you have carried forward from last year. So 3 lakh which is there, that will be taxable now in the hands of the unit holder. 3 lakh divided by 20. And the income from other sources, 8 lakh which is there, again you will divide it amongst the 20 unit holder. That will also be taxable in the hands of the unit holder. Clear? Last one, business income of D is there. That is very, very clear, taxable in the hands of the D itself, right? However, now you have the IFOS loss and the capital gain. So what will happen?
Ma'am, here I'm not sure whether the 2 lakhs can be set up against business income, but I am assuming that the 5 lakhs will be taxable in the hands of investment fund, and 20 lakhs will be in the unit holder, and 2 lakhs loss will be goes to the unit holders.
See, 2 lakh can be set off against the business income.
Okay,
Right?
okay.
First, you have to
In
apply
that
the
case,
same rules which are
okay,
there for losses. Right?
okay, fine. Then the business income 5 lakhs minus 2 lakhs, 3 lakhs will be
Correct.
taxed in the hands of business investment trust. 20 lakhs will go to unit holders.
Correct. So
Okay.
you cannot, restrictions are there for carry forward. You cannot carry forward the losses. That is the restriction. But you can certainly set off first in the same year against the different head of income. There is no problem with respect to that. Are we clear with this point?
Yes, ma'am. Thank you.
So do not get confused in the examination. See, that is the whole point, that if you do not practice, you will never come to know in the examination. You may, make this particular losses against the, fund level or at the unit holder level, but you will end up losing the marks for such a simple question because it's very conceptual. You don't need to even remember. You first apply the losses strategy, the set off strategy, which is there for any business, for any entity. Are we getting it? Then you think about, okay, Now, this is a business loss if it is unabsorbed even after the interhead, intrahead set off. Then the carry forward will happen at only the fund level. For other losses, it will happen at the in unit holder level. Any questions, any doubts so far? Yes? Any student, any doubt, any questions? Fine? Okay. Now let us move towards the next topic, which is the REIT. What are REITs? Yes.
The REIT is a real estate.
Yes. What is REIT? Yes, students, faster. What is the purpose of REIT?
Real estate regulation authority. There is one REIT setup is there, and under which there is a one SPV will be there, special purpose vehicle. The special purpose vehicle in which they will have a lot of shareholder will be there. In the shareholders, as part of the SPV, from there that the REIT what will do, the REIT will invest the amount into the SPV, on for the consideration the REIT will give their unit to the shareholder of the SPV.
Yes.
This is a overall setup on the REIT and in infrastructure development and real estate development. Here there are two income which will arise. The SPV itself will distribute the amount to the real estate REIT as by way of dividend and interest, and the real estate itself they will invest in the house property. From the house property income, they will generate income. If the house property is let out as a residential purpose, the residential purpose income will be taxed on the head income of house property as per the Chennai property case versus the Supreme Court. If that REIT is that the house property is a commercial, then it will be taxed in the heads of the business income. Here also the pass through will happen. The real estate will pass through the income to the unit holders. The taxability accordingly it will taxed. The whatever the income generated by of the letting out of the property, it will pass through to the unit holder directly. Then the REIT, whenever they are getting the income, it is exempt from tax. When you are distributing to the unit holder, it will be taxed, and also TDS also will apply 10%, and for the non-resident also rate as per enforced. Like that, the dividend income also from SPV side also they will distribute the dividend to the REIT. Then in REIT it will be exempted. Distributing to the unit holder, the taxability here. See, if that the SPV is section 11 by that is called BAC, the BBA, that is a 22% taxable category. In that case, it will be taxed in the hands of the dividend unit holder. Otherwise, it is exempt from tax. The unit holder distributing. Then, yeah, if otherwise that 11 by BAA, then while distributing a REIT to the unit holder, then the REIT will deduct the TDS as well. The dividend TDS also to deduct. Otherwise, it is not needed. Like this, interest income also, it will be taxed in the hands of the unit holder while distributing, and the REIT it will be exempted. The TDS will be 10% for the resident. For non-resident, it will be the 5%. Like this. Then the REIT also will borrow some fund from the IFSC, that unit in IFS unit, wherein any rent is repaid, the TDS rate will be applicable rate is 9%.
Yes.
this is what
Very good.
I could overall. Um,
Yes, absolutely. Very good. So basically, for those of you who are not aware about how REIT structure operates, we had the discussion in the last class also, a little bit discussion. We did not go into detail at that point in time, but let us understand how does the REIT operate, how is it different from the securitization trust. So as I said, the securitization trust is just, to help the bank give the monetization with respect to the assets that they will. AIF is a fund, right? It is just like your mutual fund, but mutual fund invest in the listed equity shares. The AIFs are basically investing into the startups and different kinds of securities, shares, right? There are multiple things. So the AIF is very, very different. Okay. Now we talk about the real estate investment trust. Now, real estate investment trust, which is there, basically that is investing in the underlying asset as the immovable property. Right? It is investing into the immovable property. Whether it is REIT, which is real estate investment trust, or InvIT, which is infrastructure investment trust. Again, these are SEBI registered entities. So REIT is when it is incorporated, right? It will either, as I said, hold directly or through a special purpose vehicle. So when the REIT is holding the immobile property directly, that's one scenario. When it wants to hold through the SPV, now SPV may be incorporated entity. SPV will have some promoters, some shareholders, right? So in order to make the SPV as a subsidiary of REIT, right, or make it fall under the REIT structure, what the shareholders of SPV will do? The shareholders of SPV is nothing but a company. We call it as a special purpose vehicles because the objective of that company is very special, is to hold the immobile property. That's why we are just naming it as SPV. There's nothing called as SPV. Okay. So the shareholders of SPV will give their shares, will give the shares of SPV to the REIT because now REIT is wanting to hold that SPV. So REIT would want the shares of that SPV, right? So let's say there is an existing company already which is holding immobile property. REIT wants to buy that company. How it will buy? It will buy from the shareholders of the company, right? So the shareholders of the company will give the shares to the REIT. REIT, instead of giving them the money, will give them the units of the REIT. REIT is going to issue the units. So when the shareholders of the SPV will give the shares and receive the units of REIT, this should be regarded as a transfer and should attract capital gain. But this is not regarded as transfer because of section 47. Are we clear?
yes,
Yes or
ma'am.
no?
Clear.
This is not regarded as transfer under 47. Yes. Everybody, others are also clear about this? Yes or no? I'm not receiving any responses from others.
Yes,
Yes.
ma'am, it's clear.
Clear? Now,
Yes.
since it is not regarded as transfer under 47, if this shareholder who is transferring the shares of SPV to the REIT, let's say this shareholder is also a company, there can be holding company of the SPV, right? There can be a corporate holding. Not necessarily an individual is holding a company. A company can also hold another company. So let's say the shareholder is a company. When it is a company, you have compulsorily MAT calculation. When you have MAT calculation in book profit, you will book this notional profit or notional loss with respect to transfer of shares in consideration of units of REIT. So this notional gain or notional loss which is debited or credited to your P&L, it is included in my book profit, and thereby I will have to pay the MAT on this. But this is not regarded as transfer under capital gain. So unnecessarily what will happen? Under normal provision, normal tax provision, this is not regarded as transfer and is exempt transfer. But for the purposes of MAT, if it is included in my book profit, I will have to end up paying MAT. So therefore, if you recollect, I told you last time also that this particular notional gain or loss has to be excluded from the book profit calculation. This is a specified adjustment under the explanation to the 115 JP. So you have to reduce the gain and add the loss back from the book profit for the purposes of MAT calculation. And when this promoter, the company promoter, the corporate shareholder, will actually sell the units of REIT, the actual gain or loss which will happen, that has to be added or subtracted from book. Are we clear up till this point?
Yes, ma'am. Clear, ma'am.
Yes.
Yes. Okay. Now, when the units of the REIT are actually sold by the unit holder, there will be capital gain. Correct. What will be the period of holding for those REIT units?
12 months or more.
12 months or more. Why 12 months? Is this listed? The answer is yes. The REIT has to list its unit on the stock exchange. So the unit of the REIT, the period of holding is 12 months. It is not 24. It's not unlisted shares. It's the unit of REIT. But from when will the period of holding start?
Ma'am, the period in which that actual shares is purchased from the SPV.
Correct. So the period of holding will start from the time when you purchase the shares of SPV, not from the time when you got the units of the REIT. Are we getting it? Yes or no?
Yes, ma'am.
Yes, ma'am.
Yes. So basically you have to start the period of holding from there, from that particular point. Then when you sell this, so you have to include the period of holding of the shares of SP. Now there may be short term, there may be long term capital gain. If it is short term, less than equal to 12 months, what will be the tax rate?
20%.
20%.
20% under 111A. And if it is long term, more than 12 months, what is the tax rate?
12.5.
12.5 over rupees
1.2.
1.2. Yeah, exemption
Yes.
is there. Yes.
Exemption is there under 112A because this is listed. Okay. What will be the cost of acquisition of the units? You have not paid any cost per se.
The price at which actual shares were purchased of SPV, that price.
Correct. Yes. So the price, the cost of the shares of the SPV will be the cost of the units of the REIT. Are we clear?
Yes, ma'am.
Yes, ma'am.
Okay. Fine. Is this clear up till to everybody?
Yes, ma'am, it's clear.
Okay. Now, when these actual units are sold, as I said, there will be inclusion of that book profit into the MAT. There will be inclusion of these actual gain or loss to the book profit for the purposes of the MAT. Okay. Now, when this REIT starts earning the income, how can it earn the income? Number one, It can directly hold the immobile property and earn the rental income from the immobile property. Right? So the rental income that it receives from the immobile property, the REIT is exempt from tax because REIT is also considered as a pass-through entity, meaning the income will not be taxed in the hands of REIT, it will be taxable in the hands of the unit holder in the same proportion or in the same nature as it was taxable in the hands of the REIT. So this rental income will be exempt in the hands of REIT under 1023 FCA and it will be taxable in the hands of the unit holder. So whenever somebody will pay the rental income to REIT, usually when anyone pays the rent income, they have to deduct the TDS under 194I. But since this income is exempt in the hands of REIT, will there be 194I? The answer is no. Will the REIT have to deduct the TDS when it pays to the unit holder? The answer is yes. REIT will have to pay. Are we clear?
Yes, ma'am.
Yes, ma'am.
So REIT will deduct the TDS under 194 LBA. If it is for the resident, it is 10%. If it is non-resident, it is going to be rates in force. Now, how does this rental income characterized in the hands of the unit holder? It is exempt in the hands of the REIT. It will be taxable in the hands of unit holder. As I said, it will be taxable in the, or it will be characterized in the same manner as it is taxable in the hands of the REIT. Are we clear? So, what will be the characterization of that rental income? Yes.
If it is a no, it will not be taxed in the hands of the REIT. It will be taxed in the hands of the unit holders.
Yeah, but what will be the characterization?
The characterization will be the same characterization. If it is a income from house property, it will be taxed in the hands of unit holder as a income from house property. If it is a commercial business, then it will be taxed in the hands of unit holder as a business. Then
Yes.
the TDS contract while giving unit the TDS they will deduct 10%.
See, whenever the REIT is investing in the immobile property, okay? Now, it is the business of the REIT to invest in immobile. That's what the purpose of REIT is. So, when your objective is to purchase the properties and rent it out, then the income from that in the hands of the REIT, will it be business income or will it be IFHP?
Ma'am, if the rental is part of the residential property let out, then it will be taxed on the head income from house property. If it is
Yes.
a commercial let out for the commercial purpose, then it will be taxed in the heads of the income from business.
Yes. So if it is residential house property, now you have an express explanation 3 to section 28, which clearly tells you that the income from the house property will be superseding the PGP. So even if it is your business to let out the house property and generate the rental income, the income from the rental properties will be chargeable under the head IFHP and not under the head PGBP. Right? But this is only in the case of residential house property. Because the explanation 3 to section 28 is only targeting the residential house property. If it is a commercial house property, if your business is to develop and rent out commercial house property, explanation 3 doesn't get attracted because explanation 3 is only for residential house property. So for commercial house property, you have the ruling of Supreme Court ruling in the case of Chennai properties, which had held that if the objective of the company is to rent out the immobile property, it will be characterized as PGBP and not IFH. So by explanation 3 to section 28, in the case of residential house property, this Supreme Court judgment has been overruled by way of this amendment. However, for commercial house property, the explanation 3 doesn't target the commercial house property. And so in that particular case, the Chennai property ruling still holds good. And in that case, for commercial property, the income will be characterized as PGBP and not house property if your business is to let out the commercial property. So in the hands of the unit holder also, it will be characterized as PGBP if the rental income is from commercial property and IFHP if the rental income is from the residential immobile property. Clear? Yes or no?
Ma'am, this residential properties case is for all or only for business trust?
For all. It is for all. But see, the concept is that if any entity is generating the income from renting out of immobile property, if it is residential immobile property, and if it is their business only to, or their objective is to, just develop the property and rent it out, then Chennai Properties case had held that this should be business income. Right? But this explanation 3 to section 28 has overruled the Chennai property case and held that even if it is your business to let out the immobile property, it will be characterized under the head IFHP still and not PGVP. So this is applicable for everybody. And REIT, why I am saying that is because for REIT, it is a business to let out the immobile property. So for REIT, also this will be IFHP and not PGVP. Why IFHP? Because of this explanation 3. And the same characterization will happen in the hands of unit holder because of the pass-through status of the REIT. Are we clear?
Yes, ma'am. As an individual, if I am doing I have many properties and I give it on rent that are all residential properties and given on rent and no other business I have, then all the income from it is income from other sources and not.
Yes. If it is residential house property, it will be income from house property only because of this explanation 3. Explanation 3 is not attracted for commercial house property, for commercial property. So for commercial property, it will still be business income.
Yes, ma'am. Thank you.
Any other question, anyone? Yes, any doubt, any question? Fine. Now, what other income REIT can have? As I said, it can directly invest in immobile property or it can invest through the SPV. If it is investing through the SPV will generate the rental income. So that is again, the same principle will apply. It will be taxable in the hands of the SPV itself. But when the SPV will distribute the income to the REIT, what income it will distribute? Either dividend or either it will be the rental income. If it is, interest income, not rental, interest income. If it is dividend income, if the SPV distributes the dividend to the REIT, what will be the taxability of that?
Exempt in the hands of REIT and taxable in the hands of unit holders.
Correct.
But if 115A will be means taken, then exempt in the hands of business trust, but taxable in the hands of unit holders.
Yes. So the taxability again for dividend, there is a pass-through status. In the hands of REIT, the dividend will be exempt under 1023 FC. Usually, when the company distributes the dividend, it has to deduct the TDS under 194. But since this income itself is exempt in the hands of REIT, there will not be any deduction of TDS under 194 by the SP. In the hands of the unit holder, you have to ask a question whether the SPV has exercised the option of tax under 115BAA, which is 22% concessional tax. If yes, then the dividend is taxable in the hands of unit holder. And in that case, if it's a resident unit holder, it will be taxable at normal rates. If it is non-resident unit holder, it will be taxable at the rate of 20% as per 115A. And the TDS will be under 194 LBA, it is 10%. And for unit holder which are non-resident also, it will be 10%. If the SPV has not exercised the option of 115BAA, meaning it is getting taxed at 30% or 25%, then the dividend is not taxable in the hands of the unit holder. Clear? Yes or no?
Yes, ma'am.
Yes, ma'am.
Now, the second stream can be SPV can pay the interest on the loan given by REIT. So if the SPV pays the interest, again the interest is not taxable in the hands of the REIT under 1023 FC. And when anyone pays the interest, they have to deduct the TDS under 194A. But here, since the income itself is exempt in the hands of REIT, there will not be any TDS under 194A. In the hands of the unit holder, yes, it will be taxable. If it's a resident unit holder, it is at normal rate. If it's a non-resident unit holder, at the rate of 5% under 115A. The TDS also will be under 194 LBA, same as dividend. For resident, it will be 10%. For non-resident, it will be 5%. And the REIT can also borrow the funds. Right? The REIT can also borrow the funds from the non-residents or any investor. If it is borrowing through the rupee denominated bonds, the bonds which are denominated in INR and which are listed on the IFSC, then the TDS will be 9% when the REIT pays the interest under 194 LC. And if it is paying to a non-resident any interest, then it will be 5%. And any other income of the REIT, any other income beyond this will be taxable at the maximum marginal rate in the hands of the REIT, and it will be exempt in the hands of the unit holder under 1023 Act. The capital gain, if it is income from the capital gain on sale of assets by the REIT, if the assets are covered under 112A, listed shares, mutual funds, right, the tax rate will be under 112A. If it is long-term capital gain on any other assets, it will be 112. If there is a short-term capital gain on assets covered under 111A, again listed shares and securities, it will be 111A. Right? And if it is short-term capital gain on other assets, then it will be maximum marginal. And this will be taxable again in the hands of REIT and will be exempt in the hands of the unit holder. So capital gain and any other income will be taxable in the hands of the REIT. All other incomes are taxable in the hands of the unit holder. Can you quote the section for letting of residential property where it will be taxable under EFOS? What letting of the residential property taxable under EFOS? Keshav, it will be taxable under IFHP, not EFOS. Okay? Is it clear up till now? Any questions, any doubt?
Clear, ma'am.
Clear? Now, any income or any payment by the REIT to the unit holders, which is not in the nature of rental, dividend, interest, right? Or any sum which is taxable in the hands of REIT. Can be any income, can be capital gain. Beyond this, if the REIT makes any other payment to the unit holder, that will be considered as the repayment of the debt or redemption of the unit. Because if you're not paying in the nature of these income, the distribution is not in the nature of income, then it means the distribution is pertaining either in accordance with the redemption of units or in respect of the some debt given by the unit holder. So distribution of any sum by the REIT to the unit holder, which is other than in the nature of dividend from SPV, interest from SPV, rental income, or any other sum chargeable to tax in the hands of business trust, which can be any income or capital gain. Anything beyond this will be taxable under section 56(2)(12) under the head income from other sources. What will be the taxability? A minus B minus C. What is A? A is sum of all the distribution made either during this year or in any other previous year by the business trust to the unit holder, which is other than in the nature of dividend, interest, capital gain, any other income which is taxable in the hands of REIT or rent. Other than this, any sum which is paid, minus the cost of units of business trust, minus amount which is already taxed under 56(2)(12) in any earlier previous year. If A minus B minus C is loss, then you will not allow the loss, you will consider as zero. And there will also be an adjustment under capital gain. So if A minus B minus C is loss, then you will reduce the amount from the cost of acquisition while calculating the units of the business trust. Cost of acquisition of the units of business trust. So basically, if you look at this, when the distribution happens from the business trust to the unit holder, which is some other than dividend, interest, rental income, capital gain, or any other sum taxable in the hands of business trust. So to the extent of the cost of the units of business trust, you will reduce the amount from the cost of acquisition. The amount which is over and above the cost of units will be taxable under 56(2)(12). Are we getting this? So let's say, for example, if the cost of unit is 10,000 and the distribution by REIT is, cost of unit is 1,000 and the distribution by unit REIT is 1,500. Out of this 1,500, interest from SPV was 500. STCG on sale of shares is 200. Other income is 100. Now, income from interest from SPV 500 is taxable in the hands of unit holder. So I will reduce from 1,500. STCG on sale of shares is taxable in the hands of the trust. I will reduce that to 100. Other income is also taxable in the hands of trust. So I will reduce that 100. So what remains is, how much remains? 1,500 minus 500, right? 1,000 minus 300, 700. What is the cost of the unit? 1,000. So when I will sell the unit, at any time when I sell the unit, so whatever will be my selling price, that will be there. But from this 1,000, I will reduce the 700 as the cost. So only 300 will be considered as cost whenever I sell the units. But let's say if the distribution by the REIT is 2,000 So from 2000, I am reducing 500, 200 and 100. Right? So 1200 is the amount which is distributed, which is over and above this incomes. Now this is more than the cost of units. Cost of unit was 1000. So 1000 minus 200. So not 1000. The distribution is, 2000 minus 500 minus 200 minus 100. Which is how much? 1500 minus 300.
1200. 1200 only.
1200. So in that particular case, under 56 to 12, what will be the amount which I will consider? 1200 minus 1000. 200 we will tax under 56 to 12. Are we clear? This should be 1200.
Can you explain it one more time? That
Sure,
first example.
Yeah, I will explain it. So, as I said, in this first case, let's say distribution is 1500. Out of 1500, 500 is interest, which is what you will any which ways tax in the hands of the unit holder under 115 UA. Correct? So we will reduce from 1500 500. STCG on sale of shares will be taxable in the hands of the REIT under 111A. 200 I will reduce that. Other income 100, this will be taxable in the hands of REIT at MMR, exempt in the hands of unit holder. So I will reduce 100 also. So 1500 minus 500 minus 200 minus 100 comes to 700. This 700 is less than the cost of unit. Right? This 700 which is there is less than my 1000 cost of unit. So what I will do is, whenever I will sell the units of business trust, at that time the cost which I will take will not be 1000. I will take 1000 minus 700, which is 300. But in the second case, the 1200 is greater than 1000. So 1200 minus 1000 will be taxable under 56 to 12. So whenever the distribution which is happening by business trust to unit holder, which is other than in the nature of dividend, interest, rent, taxable amount of income in the hands of the business trust, other than these distributions, if it is to the extent of the cost of units, reduced from the cost under the head capital gain. If it is over and above the cost of units, 56 to 12. Is this clear?
Yes, ma'am.
Any questions, any doubt?
Ma'am, is that the taxable in the hands of unit holder?
Yes, this will be taxable in the hands of unit holder.
Okay. Which means whatever we distributed already, now we are distributing that as part of the only unit sale of units. Only those cases we are computing like this, including the earlier income, whatever we distributed, we are including that, we are reducing that the current item. Then what we are seeing, what is the extra or excess or shortage. If it is a shortage, then we will do the taxation. Otherwise, we will not do it. Okay.
So basically the logic is that what we are trying to reduce is from the cost or from the what we are trying to tax under 56 to 12. We are saying that if you are distributing anything over and above this income, interest, dividend, rental income is all income taxable in the hands of unit holder. Even the capital gain, even though REIT is paying the tax on it, or any other income on which REIT is paying tax on it, it is an income which is then exempt in the hands of unit holder. But if you're distributing over and above these categories of the income, that means this was not the income. This is in the nature of repayment of capital or redemption of units. Right? So
Like buyback of
that,
share.
correct. So that we are trying to tax it under EFOS if it is paid over and above the cost of units. If it is lesser than cost of unit, that means we are trying to then reduce the cost of units because you have repaid them this amount. So indirectly, when you will sell the units, your cost will reduce. At that time, you are getting tax on it. Because when I sell the unit, my cost should be 1,000. But I am now trying to say from 1,000, I will reduce 700. My cost will only be 300. So indirectly, I am taxing 7 under the head capital. Are we getting this?
Ma'am, if REIT has made a repayment which is in excess of the cost of acquisition of units, so the cost of acquisition will become zero at the time of sale of these units.
Yes, it will become 0.
Okay.
If you make it 0, correct? You are already taxing under 56,212. See, what is happening is you are saying to the extent of the cost, reduce from distribution. Okay? So to the extent, it will become 0. Correct? Over and above that, it will be
Over and above that will be taxable under IFRS
56,212.
56 to 12.
Okay?
And
Fine.
as the units are listed on stock exchange, they will be transferred again and again by the investors, and cost of acquisition will also change.
No, why the cost of acquisition will keep on changing? Because see, this is only when the REIT will distribute that amount. If the REIT is not distributing this amount, then why the cost will change? The cost will remain the same. Only when the REIT is distributing some capital amount over and above the income, that is when you will have this problem. Otherwise, when the shares are being purchased or the units are being purchased or sold on the stock exchange, why the cost will change? The cost will remain the same. The cost will be the cost that you have paid for the purchase of units. But when REIT is distributing this additional amount to you over and above the income, at that point, you will have to reduce this from the cost.
Ma'am,
Are we
cost
getting
is
this?
what I paid for the unit,
Yes.
when I sold these units to other person, then the other person will pay me some amount, and that amount that other person paid me will be the cost of acquisition for that other person, and the
Yeah.
cost of acquisition will change.
See, that will change. Like today, if the price is 100, tomorrow price is 150. That will change depending on what you are paying. Correct? But this is having the impact, this what we are talking about from a reduction of the cost. That will have impact only when the REIT makes the payment in the nature of some capital payment. Are we getting? So today, let's say I have paid 100. Tomorrow the price is higher. So whatever we will pay, that will be my price. But there will be an impact under 56,212 or under the head capital gain only to the extent that the REIT pays me some capital amount. And that will be reduced from whatever cost that I have paid. So if my cost was 100, I will reduce from that. If my cost was 150, I will reduce from that. Clear?
Yes, ma'am.
And when you are charging under 56,212, correct? So here, if in the second example, I was charging 200. So this 200, I am already taxing it over here. Correct? Now I cannot make this cost as 1,000 to 0. Because I have already taxed 200 over here. Isn't it? So I cannot tax at both places. here I'm reducing cost from 1000 to 300 by reducing 700, because this is to the extent of the cost of unit. This amount is less than the cost. Then I'm not charging under 56,212. But here I'm charging in the under 56,212, which is 200. Here in this example, I will not reduce the cost from 1000 to 0, because I've already taxed it under 56,212. Are you getting this point? So there cannot be double taxation. Clear?
Yes, ma'am.
Okay. Any other question? Any doubt? Yes. Okay. Let's solve a question then from the module.
Ma'am, that A, B, C, in that A, they include aggregate amount of all previous years,
Yes.
not for a single previous year.
Yes.
So if we kept on transferring the units, then it will still will include all the amounts of all previous year, or for previous year for which the unit is held by the assessee.
No. Only for the unit held by the assessee. It will not include for others. So whatever amount has been distributed to you as a unit holder, to you as a capital by the REIT, that will get included, not for everybody else.
Okay, ma'am.
Okay. Fine. Let us solve a question from the module then. A business trust registered under SEBI Real Estate Investment Trust Regulation 2014 give particulars of its income for the previous year 25-26. Interest income from beta 4 crores. What they are asking us is discuss the tax consequences of the above income earned by the business trust in the hands of the business trust and the unit holders, assuming that the business trust has distributed 10 crores to its unit holder in the previous year 25-26. Assume that beta does not opt to pay tax under 115BAA. So what will be the taxability of the interest income in the hands of trust and the hands of unit holder?
Trust hands exempt and under beta will pay tax.
Yes. So trust will be exempt, correct? Because interest income is having the pass-through status in the hands of the unit holder. This will become taxable, and the nature of the income will remain the same. Plus, when it is distributed to the unit holder, the trust will have to deduct the TDS under 194 LBA. 10% if it is paid to resident unit holder, 5% if it is paid to a non-resident holder. And this entire 4 crore will not be taxable. So 10 crore is distributed. So 10 crore into 4 crore divided by the total income of the REIT will be taxable as the interest income. Clear? Fine. What about dividend income?
Exempt both the hands because 10 AA is not opted.
No, it's not taxable in the hands of unit holder. The reason is it's not opted under 10 115BAA. It is exempted in the hands of REIT, and tax also is exempted in the hands of unit holder upon distribution.
So dividend income exempt in the hands of REIT under 1023 FC. When it is distributed to unit holder, again there is no tax, because the beta, which is SPV, has not opted for 115BAA concessional rate. And the business trust is also not required to deduct the TDS because the dividend is exempt in the hands of the unit holder also. Clear?
Yes. Both the taxability and TDS is not applicable on this.
Correct. Short-term capital gain on sale of listed shares of Beta Limited, 1.5 crores.
It is taxable in the hands of business trust at the rate 20%,
Yes,
and it is exempt in the hands of unit holders.
So,
correct.
Beta Limited, which is there, it is a company listed, right? So, whenever you have the short-term capital gain on the sale of the shares of listed company, this will be taxable in the hands of the REIT itself at the rate of 20% under triple money. And it will be exempt under 1023 FD in the hands of the unit holder. Next is short-term capital gain on sale of the developmental properties.
Yes, again it's a taxable in the hands of the REIT and it taxed at the MMR.
Correct. This is other than the listed shares, short-term capital gain taxable at MMR in the hands of the business trust, and there will not be any tax liability in the hands of the unit. Interest received from investments in unlisted debentures of the real estate companies, 10 lakh.
MMR, other income.
Correct. This is other income. This will be taxable at maximum marginal rate in the hands of the business trust, and there will not be tax. There will be no tax liability in the hands of the unit holder. Finally, rental income from directly owned assets, 2.5 crores.
Yes, ma'am. This is a pass-through income to the unit holder. It taxable in the heads of unit holder. If it is a rental income based on the residential property, then it will be taxed on the heads income of house property. If it is a commercial let out, then it will be taxed in the hands of unit holder as business income subject to TDS.
Correct. So here this will be exempt in the hands of the REIT. This will be taxable in the hands of the unit holder. Right? And when the REIT will distribute this income, they will have to deduct the TDS at the rate of 10% for the resident unit holder and at the rates in force for the non-resident unit holder. The characterization of the income will depend on whether this is the residential house property or commercial house property. If it is residential house property, it will be taxable under IFHB. If it is commercial house property, it will be taxable under PGBP even in the hands of the unit holder. Are we clear? Any questions, any doubts so far?
Ma'am, I have one question. What is the relevant of 70% of the shareholding here, the Beta Limited in Indian company? 70% only they are holding the shares by the REIT, which means the 30% will be the outsider. See, whatever the interest or dividend is supplied to the REIT, is a 100% or the 70%?
So whatever information is given, that is your dividend only. So basically that is 70% on.
Okay.
So this doesn't matter, like this information is not of any relevance for this question. Just an additional information is given.
Okay. Whatever the dividend and the interest income is from the Beta is the only with respect to 70% share only, not the 100%. Okay. Otherwise, we go to put the 70% only, and that only we go to the pass through.
Yeah. Okay. Any other question? Any doubt?
Ma'am, rental income from residential house property is always taxable under the head income from house property in all cases.
Yes, in all cases. Because of the explanation 3 to section 28.
So, ma'am, all the previous case scenarios are there, no? That will be eliminated. Means,
Case
there are
scenarios as in?
जैसे रोयला या रायला प्रॉपर्टीज का
Raila
था
Corporation, yes.
हाँ
Yes.
वो सब अब नहीं
All are overruled by the explanation 3 to section 28. All are overruled in terms of the residential house property. They are still relevant only for the commercial property.
And this Chennai properties will be applicable only for commercial properties.
Only for commercial, yeah. Raila, Chennai, Raila is also deriving from Chennai. So Raila, Chennai are all applicable only for commercial. Okay, fine. So let's take a break over here for 10 to 15 minutes and then we get back with the charitable trust. Let's have a break.
Okay, ma'am.
Yes. Okay. Now, what we have seen till now is the business trust, REIT, and the securitization trust, AIFs, right? Now we are moving towards the concept of charitable trust. Regimes under the charitable trust. First regime, section 1023C. Second regime, section 11 to 13. Which are the trusts which are covered in the 1023C? Some specific trust, right? With respect to Prime Minister Fund, these funds, like, national funds, all of that. These are specific trusts which are covered in the 1023C. Second is educational institutions or educational trust existing solely for educational purposes and not for the purposes of profit, or the medical institutions, which are wholly and substantially financed by the government. What do we mean by educational trust existing solely for educational purposes? What do you mean by solely?
It has to be exclusively only for the purpose of educational, but if there is any incidental activity, that is okay, but
Yeah,
the main purpose is exclusively for that education only.
very good. So, solely for educational trust means it has to be exclusively for educational. It doesn't mean that mainly you have to do educational or predominantly you have to do education, not like that. You have to exclusively do education. You can do some incidental related activities to education, for example, hostel, bus facilities, library facilities, that's fine. And if you have some incidental activities related to education, and you maintain the separate books of accounts for the incidental activity, you are still eligible for 1023C. If it is unrelated to education, for example, you let out the school hall for some marriage function, that is not incidental. Okay? Solely. Supreme Court in New Noble Educational Society. It has to be exclusive. Plus, if you are generating revenue, if you are earning profit, that's fine. There is no bar on making the profit. It doesn't mean if you are charitable, you should not earn profit. If you earn surplus, but if you're utilizing the surplus for educational activities, then you are solely for education. But if you're taking back those profits home, that is not education. Tomorrow I may say I'm running a private coaching institute, I'm having the object of solely for education. That is not covered, that is not solely. Because it's a private educational institution or coaching institution, that my object is to take back the profits home. If I utilize those profits to impart the education, to build the college, to run the halls there, that is solely for education. Clear? What is wholly and substantially financed by government?
50%, more than 50 percentage. If it is financed by the government, then it will be treated as say example. If the receipt of income is 100 crore, then if it is more than 50%, 50 crore and above, it's more than 50 percentage means it's 51 crore. It's given by the central government. Then state government also. So both. Then it will be a substantially financed by the government.
So, wholly and substantially financed means government grants should be greater than equal to 50% of total receipts.
Ma'am,
Now, these trusts,
in
yeah,
study material I have seen is a greater than 50 percentage, not equal to.
uh,
I have seen it somewhere.
let me reconfirm. Can you tell me where exactly it is written?
1 minute, let me open the study material as well from my side.
Yeah, it's exceeding 50%. You're right. This should not be equal to.
Yeah, I don't know which page actually. I studied yesterday only.
Yeah, it is greater than 50. Yes, very good. So this should be greater than, not greater than equal to. Okay. Now, these trust, specific trusts, these education trusts which are there, these are having the unconditional exemption, meaning they don't need to apply for any approval to get the exemption. Their profits are unconditionally exempt. What about then the third category? Educational trust existing solely for educational purposes and not for the purposes of profit. So as I said, not for the purposes of profit doesn't mean that there is a bar on earning the profits. You can earn the profits, but you should utilize that surplus for educational activity. Or the medical institution where combined annual receipts are less than equal to 5 crores. So let's say there is a university, the trust is operating a university. Correct? Now, it also operates a hospital, medical college, and a hospital. University 4 crores receipts, hospital 3 crore receipts. Total is more than 5 crore, but individually less than 5 crore. It is not eligible for 1023 exemption unconditionally. It can claim. It can claim the exemption under 1023C, but it has to get the approval. It is not that it can't claim. It can claim, but it has to get approval. Less than equal to 5 crore, there is no need of having approval. It is unconditionally exempt. Then the balance category is of any other charitable, religious, medical institution, educational institution whose annual receipts are more than 5 crore. They are eligible for 1023 exemption only if they are approved. And after 1st October 2024, you cannot obtain approval under the first regime. Then both of these are merged into one regime. The first and the second regime are merged after 1st October 2024. Yeah, these three categories still continue under the first regime. Specific trust, educational institutions, medical institutions which are financed by government, educational institution which are or medical institution having the less than 5 crore annual receipts. They are still governed under 1023C. Any other will have to now go under section 11 to section 13, second regime only. Are we clear up till now? Yes?
Yes,
Any
ma'am.
questions? What about diploma and certificate courses? Whether they can be said to be covered under the educational?
If it is approved by the government, recognized
Even
by
if it
the
is not. See, even if it is not, technically, if you have annual receipts less than 5 crores, you are still eligible for unconditional exemption. So,
yes,
Supreme Court in St. Peter's Educational Society has held that even the diploma and certificate courses are eligible or are covered under educational objective for the purposes of 1023C. Fine. Now coming to second regime. Section 11. It says income from property held under the trust, wholly or partly for charitable or religious purposes. Okay, religious we can understand. What is charitable purpose? That is defined under section 215. So if the income is arising from a property or the assets held under the trust which are used wholly or partly for charitable or religious purposes, then the income is exempt under section 11. What is charitable purpose? Section 215 defines a charitable purpose to include, this is an inclusive definition, means anything can be even beyond this. Relief of poor, education, yoga, medical relief, preservation of environment, watersheds, forest, wildlife, preservation of monuments, advancement of any other object of general public utility. For the advancement of any other object of general public utility, if activities are carried out in the nature of trade, commerce, business, for cess or for fee, right? Irrespective of whether you apply that income from trade for the charitable activity, it is not regarded as advancement of the object of general public utility. So let's say, for example, if I'm doing a business, but I apply my business income for, let's say, welfare of poor, will it be considered as charitable?
no.
it will not be considered as charitable. So, if the institution is there, alright, and I have the, let's say, income from business also. Now, the business income that I have, I'm applying it for the charitable purposes. Doesn't matter what is your application. If I am doing something in the nature of trade commerce, then irrespective of the application, it will not be eligible for the charitable purpose. Whether I apply the entire receipts, whether I apply the only some portion of the receipts, doesn't matter. Are we clear about this? But there is an exception to this. What is the exception? The exception is that if the activities are undertaken in the course of carrying out the actually advancement of object of general public utility, and receipts from the activity are less than 20% of the total receipts of the trust, then even if the activities are in the nature of trade, commerce, business, it shall be regarded as advancement of any other object of general public utility. Are we clear? So, let's say for example, I may be engaged in some kind of business. I'm a charitable trust. I'm running a school. Educational activity. Right? Now, I have derived some incidental income from a stationery shop which is in my school. And I maintain the separate set of books of accounts for that. Will it be losing the charitable status?
Sorry, ma'am, what is your question, ma'am?
The question is, I'm running a school. I have earned some income from the stationery shop that I'm operating in the school. I am maintaining a separate set of books of accounts for that. Will I lose the charitable status?
No, ma'am. See, if anything is relating to education, medical, poor, yoga, and preservation, all these things is okay. Suppose if that is a case of that advancement of any other object of general utility, in that case, if that income is exceeding greater than 20%, then it will lose the status. Absolutely fine for that other objectives, no issues.
Correct. So, if my object is only advancement of any other object of general public utility, then only this exception gets triggered. If my object is any of this, then I'm not attracted by this exception. Even if in that case I'm doing trade, commerce, or business, and it is incidental to my activity, and I'm maintaining the separate set of books of accounts, then even if the trading receipts are greater than the 20% of total receipts, it doesn't matter. It doesn't matter. Are we getting this? If basically, let's say for example, my object of the institution is any other general public utility advancement. And there I have, let's say, 30 lakh received as my business income. And the total receipts which are there are, let's say, maybe, it is, let's say, 120, 130 lakhs. Now I have to then see whether it is more than 20%. If it is more than 20%, then I will not be eligible to be called as into the object of general public utility, and I will lose the charitable status. If it is less than 20%, then it is fine. And it doesn't matter if I apply that 30 lakh for relief of poor, for yoga, whatever. Once it exceeds 20%, I'm going to lose the exemption. Are we clear? Yes or
Yes,
no?
ma'am. Yes, ma'am.
So first you need to see that whether you earn a nominal markup on the cost or a significant markup. If it is significant, only then you are engaged in trade, commerce, or business, as per Supreme Court in Ahmedabad Urban Development. Because if it's a nominal markup, it is, you're not actually doing trade, commerce, or business. Then it may be the activity which is incidental to the object of general public utility. If you are maintaining separate set of books of accounts, you are not engaged in trade, commerce, or business. Are we clear? So once you are under section 11 to section 13, to claim the exemption under 11, you have to mandatorily register the trust. The trust should be registered. Without that, you cannot claim the exemption. Unlike under 1023C for certain trust where it is unconditional exemption, here every exemption is conditional on the basis of obtaining the registration. So what is the process of registration?
Ma'am, we can register 1 month prior to the commencement of the previous year, wherein we can get the provisional registration, wherein the question will be asked very less. They will not do the detailed analytical, they will not call for the documentation, everything. They will provide the validity of registration for 3 years.
Yes.
And if it is activity already started, then we can get that the registration before 6 months from the end of the quarter. Within 6 months they will provide the registration. The thing is that 5 years the validity will be there. Suppose if that trust having the business in total income previous year less than 2 crore and 2 years last before
Recording
previous
in
year, then
progress.
the validity will be 10 years.
Yes.
But it has to be looked at not both year, each year independently.
Yes. So before you commence the activity, in case you want to apply for the registration, the only way to do that is through the provisional registration. Right? So 1 month prior to the commencement of the previous year, you have to apply for the registration. And within the 1 month from the end of the month in which the application is made, the provisional registration will be passed, the provisional registration will be given without any detailed inquiry. So when the provisional registration is given, they do not make any inquiry. Right? So they will generally, not ask for any inquiry, like, give your books of accounts, give this, because it's a provisional registration. So this is given without any detailed inquiry. The registrations are given by the Principal Chief Commissioner or Chief Commissioner of the Income Tax. Right? They will not make any detailed inquiry like, if you have not commenced the activity, how can they make? Once you have already commenced the activity, then of course, they will call for your books of accounts and all of it. But if you have not commenced the activity, they cannot deny you the registration on the ground that you have not commenced anything. So we are not able to verify your genuineness. You are giving boss provisional registration. Right? So this provisional registration will be valid for a period of 3 years. The validity is 3 years from the previous year in which application is made. If the activities are already commenced, directly apply for final registration within the 6 months of the commencement of activity. And this will be valid for the period of 5 years from the AY in which the application is made, basically. So 5 years registration will be given to you if you apply for the final registration. Now, for this 5 years, there is some kind of relaxation which is given where the total income of the trust before the exemption under 11 does not exceed 5 crore rupees during each of the preceding 5 years. Preceding the year in which the application is made. So in the last 2 previous year, if your total income is less than 5 crores, in both the years, not combined, in each of the 2 preceding years, then the final registration is given for the 10 years from the AY in which application is made. Again, you can apply for final registration when the provisional registration is about to expire. If your provisional registration is about to expire, apply for final registration 6 months prior to the expiry of provisional. When the final registration will expire after 5 or 10 years, apply for the renewal 6 months prior to the expiry of final. Again, it will be given to you for 5 or 10 years respectively. When there is a modification of the objects of trust, you have to apply for a fresh registration within 30 days of the modification. If you fail to apply for the fresh registration when you modify the objects of the trust, there will be applicability of what will be applicable if you fail to apply for the fresh registration after modification?
Then cancellation.
No.
Then
Exit tax.
then existed accredited tax will apply.
Retail tax or exit tax will be applicable under 115 TD. Fine. Now, how does the trust income gets computed? You have income from property held under the trust for charitable or religious purposes in India, which will include only the gross receipts. You don't have to cover here the net receipts. In the exam, the question will say the gross receipts from the hospital is, let's say, 100 crores. Right? And the expenses were 50 crores. Here, even though the word income is used, but the view of some cases is that we need to take the gross receipts, only 100 crore. The expenses will be considered in the application of the income. Okay? So here you need to take the gross receipts. Second, voluntary contributions. Any donations that you receive, voluntary contributions you have to take. Other than the corpus donation. Other than the corpus donation. Corpus donations we do not need to consider in the income. Corpus donations are not income. Except if the anonymous donations are received as corpus donation, then it's not exempt. If you get the anonymous donation as the corpus donation, that is not exempt. That you have to consider. Any other corpus donation is exempt. It is not income, provided you deposit in the mode specified in section 11.5. Any corpus donation that you receive for repair or renovation of religious trust, again, that is not considered as income if you apply it for the renovation and repair of religious trust. The amount you are not utilizing, that corpus donation you do not utilize for making the donation to some other trust, or you invest in the mode specified in 11.5. Then corpus donation is never an income. Yes, if you receive the corpus donation as anonymous donation, then it is not exempt. It will be in fact taxed under 115 BBC. If you get for repair or renovation, that is also not income, provided you fulfill these conditions. If you fail these conditions, if you violate these conditions, then it is deemed income in the previous year of violation of conditions. Anonymous donation, it is your income, whether it is voluntary, whether it is corpus, it is income. So it's taxed under 115 BBC at the rate of 30%. Up to a limit, it is exempt if it is applied for charitable purposes. What is the limit?
Ma'am, we have to consider the total contribution, including a voluntary contribution, corpus donation, anonymous donation, everything we have to consider in all together. Out of which we have to find what is the 5%. We have to keep one
Yes.
side. Another side is 1 lakh. Whichever is higher, we can claim exemption. In addition to
Correct.
this, whatever there is left over, that will be taxed 30%, 115 BBC.
Yes. What is the limit for anonymous donation? 5% of total donation or rupees 1 lakh, whichever is higher. Beyond this limit, it will be taxed under 115 BBC at the rate of 30%. Up to this limit, you will claim it as a normal income and claim it exempt if it is applied for charitable purposes. 5% of total donation. What is total donation? Will include voluntary contribution, corpus donation, anonymous donation. 115 BBC is not applicable if trust is created wholly for religious purposes, or the trust is created partly for religious, partly for charitable. Then in that case, the 115 BBC will apply only if the donations are received for educational or medical institution. Clear? So let's say, for example, if the total donation is 15 lakh, anonymous donation will be 4 lakh. What will be my exemption in these cases? 1 lakh or 5% of total donation to that limit. So what will be my exemption? What is 5% of 15 lakh?
75,000.
75,000 or 1 lakh, what is higher? 1 lakh. So 1 lakh will be taxed as normal income. You can claim exemption with respect to the 14 lakh. Sorry, not 14 lakh, 12 lakh. Right? But 4 lakh minus 1 lakh, 3 lakh will be taxed directly under 115 BBC. Clear? In the second case, 30 lakh is the total donation. 7 lakh is anonymous. What is 5% of 30 lakh?
1.5 lakhs.
1.5 or 1? 1.5 is higher. So 1.5 lakh, I can claim the exemption if I apply for charitable purpose. 5.5 will directly taxed under 115 BBC. Next item, 40 lakh, 10 lakh is the anonymous. What is 5% of 40? 2 lakh.
2 lakh.
2 lakh is higher than 1 lakh. So 2 lakh I can claim exempt if I apply for, it's not straight away exempt. You have to apply for charitable purpose. But 8 lakh, we will tax it under 115 BBC. Is this clear, students? Yes?
Yes, ma'am.
Okay. Income from government securities or grants, that you will also consider as income. And then finally the capital gain, sale consideration minus the cost of acquisition. Now what is considered as the application of the income of the trust? First you get the ad hoc exemption of 15%. Meaning this 15% you don't need to necessarily apply for charitable purposes. You have to invest that in the mode specified in 11.5. But you don't need to really apply that income for charitable purposes. So that is the first ad hoc 15%.
Ma'am, I think ad hoc exemption 15% is right. I think it is need not be invested in section 11.5, I believe. See, if the
No.
amount, I think it is not, it is unconditional. We can use it for any purposes. The
You
investment
can,
is not the, ma'am, in study material is provided, I have seen it, but say balance 85% is very clear. If anything 85% is not applied, then the balance left over has to be invested in specified mode in 11.5, not the 15%.
I'll show you in the study material also, if you look at this. What they have said here. The exemption is available only if at least 85% of the income is applied for charitable or religious purposes. 85% you have to compulsorily apply. You have to use it for either operational expense, for either capital purchase, capital asset purchase, for the charitable activity, for construction, whatever. And the remaining 15% is invested in the forms or modes specified in 11.5. Are we getting this? So it is not that you can, spend or keep 15% wherever you want. You have to apply 15% for the mode specified in 11.5. It is not mandatory that you have to use for charitable. You can keep it in mode specified in 11.5. You cannot keep it idle, or you cannot take back home, or you cannot apply for private purposes. Are we getting this point? So they are saying mandating you to 15% spend it. Keep it in mode specified in 11.5. Keep it in FD. Keep it in security, government security. Are we clear?
Yes, ma'am. Yes, ma'am. I'm seeing this. I'm okay. Let me check it out 1 second. Okay. I will go through and come back to you, ma'am. Please.
See, it is written in the module itself.
Yeah, it's okay. It's very clear now.
Yeah.
But somewhere I have seen it. That's what now I am clear now. Thank you.
Yeah. Yes. Any other question?
Ma'am, whether this trust can have income from outside, means international, means
It
all
can, but
income.
will not be eligible to claim the exemption with respect to this. It has to apply. See, trust can receive the contribution and they have to register under the Foreign Contribution Regulation Act, right? But they need to apply here in India, that income also. If they apply outside India, they will not be able to claim the exemption. It is not that the trust can't receive the foreign contribution. They can, but they need to, get that only in consonance with the FCRA regulation, FCRA Act, Foreign Contribution Regulation Act. Fine.
Yes, ma'am. Thank you.
Also, with respect to this 15%, see what I told you? There is this Supreme Court ruling in the case of CIT versus Program for Community Organization. 15% of the gross receipts and not the net receipts would be eligible for accumulation. You don't need to reduce any expenses. You have to take 15% of the gross receipts for the accumulation under section 11.1. Are we clear? Yes or no?
Yes, ma'am.
Okay. Now, balance 85%. Balance 85%, you have to now basically apply for the operational, for capital purchase, whatever expense you want to use. 15% you don't need to apply. You can invest in the mode specified in 11.5. This is also in line with the circular reference which is given over here. CBDT Circular 335. Now, how can I use the balance 85%? I can use for operational expense. That will be allowed as application. But the expenditure are allowed only on the actual payment of expenditure, even if the trust follows the accrual system of accounting. But the operational expenditure will be allowed as application only when you actually pay. So, if you have incurred, but you have not paid, you will not get it as application. Or if you have paid the expenses in cash more than 10,000, either current year expense or the last year expense. If it is, outstanding, it will appear as an opening balance. So if you pay your opening balance in cash more than 10,000 or your current year, not allowed as application. Or the expenses on which tax is not deducted or deducted but not. So if you deduct or not pay or do not deduct before the due date of 139.1, 30% of expense, just like 40A1A will not be. Then what else is considered as application? As I said, purchase of capital asset. But if you claim the purchase of capital asset, you cannot claim the depreciation on the capital asset as the application. Are we clear? Then repayment of loan. When you repay the loan, right, that will be considered as application. When you apply the loan, let's say I've taken the borrowings, I'm paying salaries from the borrowing. That will not be considered as the application. So when you repay that loan, then it is considered as application. When I apply the loan, that is not considered as application. So when I repay the loan, the application from the loan should be in India. The application from that loan should not have been for corpus donation to another trust. If any expenses are paid from the loan, the tax should have been deducted. Expenses should not have been more than 10,000. The application from the loan should not be for the benefit of any specified person under 13(3). And the loan should be repaid within the 5 years from the previous year in which the application is made. Clear? So if I take the loan and pay the salary, that is not application. When I repay the loan and fulfill these conditions, that is the application. Similarly, when I get the corpus donations, corpus donation is exempt, isn't it? Corpus donation is exempt.
Yes, ma'am.
Unless it is anonymous donation received as corpus, right? So the application from the corpus donation is also exempt. So let's say I receive any voluntary contribution with specific direction that it will form part of my corpus, and I use that amount for purchase of building. That's not application. Okay? That is not application. That will be exempt. Then the application from that will not be allowed as the application.
Because that we already exempted that corpus.
Correct. We have exempted that corpus.
Ma'am,
But when I deposit back to the corpus from my current income, that is considered as application. If I deposit the amount in the mode specified in 11.5, that is application. Provided the application from the corpus should have been in India. The corpus donation is not paid to any other trust as corpus donation. Whatever expenses are made from corpus, TDS is deducted. Expense should not be more than 10,000. The application from corpus should not be for any specified purpose. And I should invest back the amount in the corpus within 5 years from the end of previous year in which application is made from corpus. Clear?
but corpus to corpus, we should not donate to another charity. That is also not allowed. Ma'am, actually, I confused in the case where the 15% ad hoc exemption not to be the mode to be deposited in the mode specified in section 11.5 is true, but when the charitable institution is giving the donation to other charitable trust, wherein say example 100 crores is given to them, out of which 85% will be only considered as the application of fund, wherein the 15% has to be the mode specified in need to be deposited, but that is not needed actually in that case because we don't have money. So CBDT circulars is given. I actually a little bit confused with that part only. I am very clear on this part now, ma'am. I just rechecked. Okay, concept is very clear now. Thank you.
Okay. So next is when I make donation to another trust, which is registered under 12AB or 1023C. If I give that donation from the corpus, if I give that donation from my corpus, not allowed. It should be from my current income. It should not be paid from my accumulated income. That is not allowed. It should be from my current income. That is allowed. Irrespective, if my object is, let's say, educational, their object is relief of poor, fine. I'm giving a donation to another trust. That is for charity. Allowed. But it should be from current income. What is allowed is 85% of donation. If I give the donation to another trust towards their corpus, no, that is not application. I should give for their
Current
normal
income.
routine, not for the corpus. And I should not pay from my accumulated income. Now, the problem that was coming is, let us look at the module to understand and appreciate the CBDT circular. So, let us say, for example, 100 rupees or 300 rupees is the income of trust fund. Right? Now, 15% is ad hoc exemption that they will invest in mode specified in 11.5. What they are required to apply? 85%, which is 255. Out of which they give the donation of 100 rupees to trust one, trust two. Right? They give the donation of 100 rupees to another trust. That will be considered as application. Correct? But what does the law say? Only 85% of that amount will be considered as application. 15 will not be considered as application. So what will happen? 85 only, even though I have donated 100 rupees to another trust. But what will be considered as my application? Only 85. Now, then what do I do with this balance 15? What is the balance income left after application? Out of 300, 15% is ad hoc. That's gone. That I have to invest in mode specified in 11. Correct? 255 is what I am required to apply. Out of which my application is being considered as only 85. So technically, I have to still apply the balance amount. But I'm left with only 200 rupees. How do I apply 15 rupees when I do not have that? I have given this 100 minus 85 is being considered as my application. 85 is considered as my application. Right? But the 15 rupees, which additional I have given to trust 2, how do I apply that? I don't have that money with me. I'm already donated. Are we getting this? So, technically what I'm left with application is 200. Right? Technically I'm left with 200. Are we getting this problem? Yes or no?
Yes, ma'am.
So,
This is what I discussed.
yeah. So, I am left with 200 only. I don't have additional 15 rupees. I don't have 215. I'm left with 200. So, what the CBDT circular has said that in this particular case, when the trust gives the donation other than corpus donation to another trust, the act says only 85% of the amount paid is considered as application. Right? Which is 85. But the 15 rupees which is there, how can I invest in mode specified in 11.5 if the entire 100 has been donated? So I had to apply that 15% in the mode specified in 11.5 of entire 300, right? But out of this, I have already donated 100. How will I calculate 15% of 300? Right? So the 15 rupees of 100, how will I contribute? If I do not have is what the CBDT circular is telling us. So we have to only
Recording in progress.
Yes or no?
Yes,
Fine.
ma'am.
Okay. Let us move further then. Now, if the trust is not able to apply its 85% of income because the income is received late. Let's say income is received 15th of March, 20th of March, 31st of March. How do I apply the income in last 1 week? Then the option is given to the trust to consider as a deemed application that the income will be considered as deemed to have been applied if you file Form 9A before the due date of filing the return of income. If you apply this income in the immediately next year, let's say I receive in 25-26, then I apply it by 26-27, it will be considered as deemed application. If you do not receive, so if the income is not applied in the 26-27, then this will be taxable under 115 BBI as a specified income. Or I am not able to apply the income because I have not received the income during current year. It was accrued but not received. If it is accrued but not received, how will I apply? Again, you have an option to file Form 9A before the due date of filing return of income. That I have not received the income. It will be deemed that the income has been applied. It will not be taxed. But the condition is you should be applying this income when you receive it or in the next following previous year of receipt. So if it is not received in 25-26, you receive in 26-27, you should apply by 26-27 or 27-28. If you do not apply, then in the previous year of 27-28, it will be considered as your deemed income taxable under 115 BB. Are we clear? Yes or no?
Yes, ma'am.
Okay. Now, if I have received the income, it is not received late. I have received also during the year, but I was not able to apply it because I'm going to plan a project, a school, or a hospital, whatever. The trust has the option to accumulate the income. Okay, you don't want to apply this year, don't apply. You file a Form 10 stating the purpose that I want to accumulate this income. So don't tax it now. It will be considered as deemed application. But the maximum period of accumulation will be 5 years. So if you file Form 10 before the due date of 139 month, and if you put this accumulated income till the time you apply it in the mode specified in 11.5, and you also file your return of income on time, it will be considered as the deemed application. Are we clear? But if you fail to satisfy this condition, that if you have accumulated income but you do not apply for charitable or religious purposes, then it will be deemed income of the year in which you have applied for other than charitable or religious purpose. Or you have ceased to remain it accumulated in 11.5 months. You have withdrawn. It will be income of the previous year in which it is ceased to be accumulated or ceased to remain invested in the mode specified in 11.5. Or if you have not utilized for the purpose for which it was accumulated. Let's say I had filed Form 10 stating the purpose I want to build hospital. I don't build the hospital. And I had said I would build it in, let's say, 3 years. I don't build it in 3 years. So in the last year, the third year, it will be considered as the deemed income. Or I pay this accumulated income to any trust. Remember I told you, any donation from accumulated income to any trust is not considered as the application. The donation to other trust should be from current income, not from accumulated income. If you pay from accumulated income, it is deemed income in the year in which income is paid to trust under 115 BBI. Are we clear? Yes, clear?
Yes.
Yes, sir. Yes,
Yes, ma'am.
everyone? Yes, all other students, is this clear?
Yes, ma'am.
Okay. Now, in respect of capital gain, remember we discussed the capital gain is also considered as your income, right? We discussed sale consideration minus cost of acquisition. Now, what is application from capital gain? So, if the entire sale consideration is utilized for acquiring the new asset, entire capital gain is deemed to be applied. Where only part of the sale consideration is utilized for acquiring the new asset, then the application will be cost of the new asset minus cost of the old asset. Fine. Now, coming to this deemed income category that we were talking about, section 115 BBI. When is the income set to be charged under this deemed income category? As I said, the income is accumulated but is not utilized for charitable or religious purposes, or you have not filed the form 10 and the return within the time, or the income ceased to remain accumulated, or it ceased to remain invested in the mode specified in 11.5, or it is not utilized for the specified purposes within the specified time, or it is paid to any trust. This deemed income. Second, income not received during the previous year and even not applied in the year of receipt or in the next previous year. Or income received late but not applied by the following year. That is deemed income. Or income applied for the benefit of the prohibited person under 13(3). All these income will be taxed at the rate of 30% on the gross basis. That means you will not get any deduction of expenses against these income. Clear? Any questions, any doubt? Yes?
Yes, ma'am.
Fine.
Clear, ma'am.
Now, when can the trust registration gets denied? Let's say income is held under trust for any private religious purposes or for any particular religious community or caste. The exemption will deny. Or the income of the trust is applied for the prohibited person under 13(3). Who are the prohibited person under 13(3)?
Employee, the person who given the donation for the month 1 lakh rupees or in aggregate of the whole year more than 10 lakh rupees, and the beneficiary of that author, trustee, all those persons will involve.
Yes. So 13(3) says prohibited person are settler, author or founder of the trust, trustee of the trust, relatives of the founder or the trustee, any contributor to the trust whose contribution is greater than 1 lakh or 10 lakh in aggregate, where the founder is the HUF, members of the HUF, any concern in which these above person have substantial interest. If the concern is company, substantial interest means 20% of voting power, more than 20%. If it is other than company, greater than 20% of the profit share. Right? Now, income is deemed to be used for the benefit of prohibited person when you are giving interest-free loans or loans without adequate security. Or they are using the property of the trust without adequate rent. Or some excess sum is paid for services. Or the services are provided by the trust for inadequate remuneration, etc. excess payment is made for the purchase of the property or securities from these persons. Inadequate payment is received for property or security sold by the trust to them. Diversion of income or property more than 1,000. Or investment in a concern by a trust in which prohibited person has a substantial interest. If the investment by the trust is more than 5%. If the investment by the trust is less than 5%, then the exemption is denied only with respect to the income from that investment. With respect to remaining investment, the exemption is allowed. Are we clear? So, in that case, if the income of the trust is applied for benefit of prohibited person in the hands of the trust, there will be denial of exemption. There will be the taxability under 115 BBI at the rate of 30% on gross basis. And there will also be penalty under 271 EE, 100% for the first violation of the income applied, 200% of income applied for the next violation. And in the hands of the prohibited person, there will be 56 to 10 applicable. Clear? There will be denial of exemption if the deposit of the funds 15% accumulated is in modes other than section 11(5). Now this doesn't apply to the funds invested out of the business income. Yes? Or if the assets are held for less than 1 year. If the business income is incidental income to the charitable, then this applies. But if the funds are invested out of trade, commerce, business, then this doesn't apply because that's not for charitable. Or if the assets are held for less than 1 year. Again, there is denial of exemption if you have anonymous donation. So, over this limit of 5% of total donation or 1 lakh, whichever is higher, over and above this, with respect to that amount, the exemption is not available. Balance amount, the exemption is still there. If the trust is having the object of advancement of general public utility and the trading receipts are greater than 20% of total receipts, then also the exemption gets denied. Or if the Form 10 is not furnished before the due date or return of income is not furnished for accumulated income, the exemption will get denied. Are we clear? Yes or no?
Yes, ma'am.
Fine. Now, if the benefit is provided in the educational institution or hospital to these prohibited person, then exemption will not get denied unless the service or the education or the hospital treatment is provided free of cost or at concessional rate. Just because you're providing them at the proper charges, that's not problem. If you're providing a concessional rate of free of cost, then the exemption will get denied. Okay. Now, when the trust has the business income for which separate accounts are not maintained, then the business income will be taxed as the AOP's income. Clear? Now, when the specified violations occur, denial of registration is one thing. There will also be cancellation of registration. So, if the income of the trust is applied for other than the objects of the trust, or trust has business income which is not incidental to objects, or trust has business income incidental to objects but separate books of accounts are not maintained, or income is applied for private religious purposes or for benefit of particular religious community or caste, or the activities of the trust are not genuine or not in accordance with the conditions of the registration, or the trust has not complied with any law, or the registration is obtained with false information, then the registration of the trust gets cancelled, plus if the registration of the trust gets cancelled, then there is also a tax on the accreted income, which is also we call it as the exit tax. Taxable under section 115 TD at the rate of 30% plus surcharge of 12%, which is a compulsory surcharge, and 4% cess. Are we clear? Any questions till now?
Clear, ma'am.
Okay. Now, what is this exit tax when this exit tax is applicable? When the trust converts itself into a non-charitable organization. Now, a trust is deemed to be converted into a non-charitable organization when, as I said, the registration of the trust is cancelled. So, when the registration of trust is cancelled, on what basis it can get cancelled? On occurrence of the specified violation. So, if any of these specified violation occur and the registration of the trust gets cancelled, then it is deemed to be converted into a non-charitable organization. Or the trust has modified its objects and has not applied for fresh registration. Remember, I told you that when the trust modifies its object, it has to apply within 30 days for fresh registration. But if it has not applied, or it has applied but the application is rejected, it is deemed to be converted into a non-charitable organization. Or where the trust has failed to apply for re-registration, where the registration is due to expire, or final registration is not applied, where the provisional registration is to expire. In these cases, the trust will be converted into a non-charitable organization, right? And it will be, the exit tax will become applicable, right? And they have to pay within 14 days from the date of order of cancellation or date of modification of the objects, the accreted tax. Second scenario where this exit tax is applicable. Merger of a trust with an entity not having the similar objects and registered under 12AA or 12AB or 1023C. It's fine if it is registered under 1023C. So if it merges with another trust which is not registered and not having similar object, it will be liable to exit tax. The exception is if the trust merges with an institution which has similar object and which is registered under 12A or 12AB or even under 1023C. Fine? Or if the trust gets dissolved and if the trust does not distribute its assets within 12 months from the dissolution. In that case also, the exit tax is applicable. Now, the exit tax is applicable on the accreted income. What is the accreted income? Yes. What do we mean by accreted income?
Accredited income, we have seen a lot of list is there that if the trust is accumulated income, if it is donated to some other trust, then that will form part of like that. So many things it will order.
Yeah. See, basically, accreted income means FMV of the total assets as on the specified date. What is specified date? In case of cancellation of the trust registration, the date of order of cancellation. In case of the modification of objects, date of modification. In case of failure to get the re-registration, then date of making the application. In case of merger, date of merger. In case of dissolution, date of dissolution. So whatever the FMV of total assets is as on the specified date minus the total liability will be considered as my accreted income. We'll see how to calculate the FMV. The FMV of the assets is, if it is immobile property, higher of stamp duty value of immobile property on the specified date or the open market value. In case of quoted shares in security, average of opening plus closing as on the specified date or prior to that date. In case of unquoted shares, A plus B minus L into PV divided by P, same as your 11 valuation. A is equal to book value of all assets minus income tax plus income tax refund minus unamortized expense. B is basically the FMV of jewelry, painting, immobile property. And C is the book value of liability. L is the book value of liability excluding paid up share, reserve surplus, contingent, provision for tax, provision for uncertain. P is your total equity share capital. PV is of the paid up value of that equity share. For other than equity shares, value as per the valuation. This is your FMV of total assets. For liability, you will take the book value, you will exclude the corpus, reserve surplus, contingent liability, provision for uncertain, provision for tax. This will give you your accreted income. In this FMV of total assets or liability, you will exclude the asset liability generated out of agricultural income, which is exempt under 10(1). Asset or liability transferred to a trust which is registered under 12A or 12AB or 1023C within 12 months of dissolution. You will also exclude any asset or liability generated out of income prior to the registration, because only after the registration your income has gone exempt under section 11. Before you obtain the registration, your income was taxable. So any asset or liability you generated, that's fine. Because the concept of exit tax is that only when you have been, earning the exempt income and suddenly now you are going to cancel your registration, modify your objects, do not obtain registration or do the merger with another trust which is not registered under 1023C, or you dissolve. And now you are, whatever assets you have created out of this exempt income that we have given you the exemption over the years. Now you are going to use this asset to generate the taxable income. Or you are going to use the asset for private purposes. That's not allowed. That's the exit tax. That's why the exit tax is levied. So any asset or liability generated prior to the registration will be excluded. Are we clear? Shall we solve one question on this?
Yes, ma'am.
Let us look at the module. Yes. Serving the poor, a charitable trust is registered under 12AB on 1/4/2025, got merged with another entity. Okay, let's do the 7th one. That's, I think, more suitable. Helpage is a charitable trust set up on 1/4/10 with the object of providing relief to poor. Later in April 12, it changed its object to medical relief. It applied for registration on the basis of new object on 1/9/12 and was granted under Section 12 on 1/2/2013. On 1/4/2025, Helpage got merged with Poor Aid, is not eligible for registration under 12AB or 1023C. All the assets and liability of erstwhile trust became the assets and liabilities of the Poor Aid. The trust appointed a registered valuer for the valuation of its assets and liability. Following are the particulars. Calculate the tax liability in the hands of trust as a result of merger. The location of the land is given, date of purchase is given, stamp duty value as on 1/4/25 is given, value as per the open market value is given, and book value is given. So first for the Noida land, what will you take?
Stamp duty value or the land fetch open market value, whichever is higher. But in this case, that the year of purchase is 2010. At that time,
Yes.
the application of land purchase, it's not application of income for the trust. Hence, it's not
Yeah.
considered.
We'll not consider this because this is purchased in 2010. If you see, it has applied for the registration on 1st September 12. So prior to the registration, and it has got the registration on 1 to 13. So before 13, if any asset is purchased, that will not form part of the assets for the purpose of accreted tax. What about the Gurgaon land?
Gurkhan this is applicable. We can apply higher of stamp duty value or open market, which is 120 lakhs.
Correct. We'll take 120. With respect to shares, 5,000 quoted equity shares of A Limited. We have date of purchase, we have the face value, we have the purchase price, we have the highest and lowest price quoted on the BSE, and we have the open market value as on 1/4/25 on the basis of the report of merchant banker.
And the quoted shares, higher of lowest price and highest price average rate 320, 300, 310 in multiplied by 5,000 shares. It will come
Correct.
15 lakhs, 15,000, 50,000.
Correct. So 320 plus 300 average of this, because these are quoted share, multiply by 5,000 share, because this is the each share price. So that you will take. What about the preference shares? 2,000 preference shares of B Limited.
This is open market value 180 into 2,000.
Correct. This is other than the shares, equity shares. So 180 is the open market value as per the valuation report into 2,000 shares we'll take. Now, book value of liabilities is 120 lakh. This includes the corpus fund 12 lakh and the provision for tax 8 lakhs and the reserves and surplus 18 lakhs.
We have to reduce all these three items because we should not include these items. Since already included in 120 lakhs, 12 lakhs we have to reduce, 8 lakhs and 18 lakhs, all the three items to be reduced.
Correct. So we will reduce all the three and we will consider the book value of the liabilities. Are we clear? So basis that we will consider the amount of the total assets minus the total liability. What will be the accreted tax on this? Yes. What is the amount that you are getting?
30%, ma'am.
Yeah. So what is the amount?
Amount the liabilities is 82 lakhs. Yeah, please show the slide up. I missed out the calculation. I need to total it.
Okay, let's look at the solution for this. So this is the land at Gurgaon, 120 lakhs. Quoted equity share 310 into 5,000, 15 lakh 50. Preference shares comes to 2,000 into 180, 360. And the total liability comes to 82. So 82 lakh is the answer. So what is the tax liability?
139 minus 82. 57 lakhs. For 57 lakhs, we have to put the tax rate 30%.
Correct. 57 lakh 10,000.
30% plus 12% plus 4%. 34.
Comes to 19 lakh 95,300.
Yeah, effective rate 34.944.
Fine. Any questions, any doubts so far? Okay. Yes or no? Any questions, any doubt anybody has?
No, ma'am.
Fine. Oh. Now, coming to the last concept before we close the session. Taxation of the private trust. Very, very small topic. And the political party. For private trust, there are two kinds of trust, revocable and irrevocable. What is revocable trust? Any idea?
After transferring the asset, anytime they can be revoked by the transferor.
Revocable trust is under 63, which says transferor has either the power over the income or the assets transferred, or the assets or income can be retransferred to the transferor. In that case, the income will be clubbed in the hands of the transferor itself under section 61. Then there is irrevocable trust, which says the transferor derives no benefit from the income or the asset, and it is irrevocable during the lifetime of beneficiary. If the income is taxable in the hands of trust itself. In that, we have two categories: specific trust, discretionary trust. Specific trust is where the beneficiaries' shares are specified. In that particular case, if you do not have business income, then the share of beneficiaries is taxable in the hands of beneficiary at the slab rate. If there is business income, it will be taxable at MMR. In case of discretionary trust, if there is no business income, it will be taxable at MMR only. The trustee is taxed in the representative capacity. And if there is PGBP also, then also it will be MMR. So for discretionary trust, it doesn't matter. For specific trust, it matters whether it has a business income or no business income. Also, if the income from the asset is transferred to a trust, if the asset is transferred to the trust for the benefit of either the spouse or daughter-in-law for inadequate consideration, then the income from that asset is going to be clubbed in the hands of the transferor as per section 64. Fine. So that's
Ma'am,
about the private trust. Yes.
ma'am, for the private trust, for the income from PGPB, then on that stakeholder point, it's taxed, or on the trust, where it will be taxed, ma'am? Beneficiary or trust?
In which case?
Specific trust, when there is
Yeah.
no BGPB, then taxed in the hands of beneficiary. When there is a BGPB, on whom it is taxed?
Trustee.
Trust. Okay. Trustee. Okay.
Trustee is taxed in the representative capacity when it is PGPP because trust is carrying out that business.
Okay. But here, when there is no BGPB, the situation is different.
Yes. Then the share of the beneficiaries will be taxable in the hands of beneficiary at the slab rate.
Okay. Fine. Got it.
Now then we have the political parties. Their income is also exempt under section 13A. Electoral trust, same. We have the income exempt under 13B. For political parties, the exemption is with respect to IFHP, income from other sources, capital gain, and the voluntary contribution. But the exemption is conditional. What is that? They should maintain the books of accounts plus get the books of accounts audited. They should maintain the records of the voluntary contribution greater than 20,000. They should not receive any donation in cash more than rupees 2,000. And they should mandatorily furnish the income tax return. Are we getting it? Even for the trust, even for the charitable trust, this condition is there, students. They need to maintain the books of accounts and get the books of accounts audited, plus file the income tax return, even for the trust, charitable trust. In order to avail the exemption, the entities either under 1023C or 12AA, if their total income before the exemption is greater than the basic exemption limit, they have to mandatorily file the return. They have to maintain the books of accounts mandatorily and get these books of accounts audited. Right? So, the report of the audit is required to be furnished in Form 10B or 10BB. 10B is where they have the total income more than 5 crores or they receive the foreign contributions
Or
or if they have
paying to the
applied the
foreigners.
income outside India.
Yes.
Sorry? Yeah?
Yes, ma'am. There are three conditions: exceeding
Yes.
5 crore, and receipt of free receipt from foreign countries apply to the
Yes.
outside India.
Correct.
10B.
Yes. And 10BB in all the other cases. Plus, they need to maintain all the set of books of accounts for the period of 10 years. They need to maintain the books of accounts like for the charitable trust, their normal books of accounts, the bills that they have, their basically records of all the projects that they are running, whatever donations that they are receiving, whatever properties or assets that they have held, whatever income that they are applying basically, either in India, outside India, the income accumulated, the funds invested in 11.5, all of that they have to maintain in detail. They have to maintain in detail their properties held, their loan or borrowings, the amounts received from specified person, all of that. Clear? If they do not, then they will lose out on the exemption. Clear? Any questions, any doubt?
No, ma'am. Ma'am, with respect to electoral trust, there is a 95% application. What is that, ma'am?
Sorry, what? With respect to the
Electoral trust, there is a exemption is there. What about 95% criteria is there? I could not understand that concept actually.
see, with respect to the electoral trust which is there. So in that particular case, we have the exemption under 13B. Okay. Now what they say is that in respect of the electoral trust, the condition for exemption is that any voluntary contributions would be exempt if the electoral trust distributes to a registered political party 95% of the donation received by it. So let's say it is receiving 100 lakhs, 95 it should distribute to a political party registered with it. Are we getting it? So
Which
that is
means,
the only condition.
okay, which means that from electoral trust to that political party, that is 13A.
Yeah.
Okay, only to them it is applicable. Is any other person they can contribute
No,
that
no, to a
receipt?
registered political party only.
Okay. Electoral bond.
Yes. Electoral bond is different. See, this is electoral trust. Electoral bond is just a bond which is issued by the basically a scheduled bank under a scheme which is there. So that is different. That basically is with respect to the political party. So a political party's income is exempt. These four category of income that we have discussed. And the condition for them is that they maintain a record of the voluntary contributions. They should not receive any donation more than 2,000 in cash, right? And they should furnish the ITR, submit the reports and all of that. So basically this political party raised the money through electoral bond. They receive the contribution through the electoral bond. That is different.
Okay, electoral bond given by the corporate or somebody else to political party.
Yeah.
Okay, they will get it from the bank and they will give to political party. They will claim the fund. Okay.
So let's say, for example, if they get the funds to electoral bond and they do not maintain the books of accounts, they do not have any details of the amount received, then in that particular case, income will be taxable. Okay.
Okay, ma'am. Okay, ma'am. Got it. Thank you.
Yeah. Any other question, any doubt? Yes.
Thanks for the comprehensive review for entire chapter in 3 hours, ma'am. Thank you.
Okay, thank you so much. If there are no questions, I think we can close the session. Thank you so much. In the next class, we will have TDS, TCS. So again, please revise and come so that it will become easier for you to discuss and solve the answers. Thank you so much.
Okay, ma'am. Thank you. Good night.
Good night. Yes.
Thank you.